is up, guys? So, what I want to talk about today is bear spreads and why I take them. So, in the past, thanks to Bear Bull Traders Education Center, I started to learn a lot more about options and have been adding to my weekly total by selling weekly calls or puts. Sometimes I do slightly longer time frames, like 2 weeks or a month out, etc. So it really depends on the ticker. So for example, DRV only has monthly contracts. So depending on how I think the stock will do a month out, I would sell a call or buy a put, etc. And usually I would own the underlying as well. And so that's sort of what I've been doing. This past several months in 2023, I've been doing a lot more bear spreads. So that's what I want to talk about today. And the reason why I've been taking more of these is because of the very poor economic conditions in the real world. I'm not going to go through all the indices or reports, sometimes unreliable with doctored figures. You guys can think about all the other revisions that we've had in inflation reports that's been moved up after they've been under-reporting, and same thing with like the unemployment reports, etc. The whole Democratic administration is just corrupt and it's a huge mess. No one knows what they're doing. But overall, I feel like this points to a very bleak future, and so that's why I've been taking a lot of short positions, and I do a lot of bear spreads. So that's why I like to use this as a way for me to both hedge and also take short positions on some relatively higher price stocks without actually shorting the underlying. This way I have less capital at risk, my risk is capped, and also less drawdown on my buying power as well. So I'm not going to go through too much of the technical aspect of taking this. People can look to someone more experienced on options trading like RD and the Education Center on Bear Bull Traders to learn more about it. However, I do want to mention that a bear bull spread really depends on whether you're buying or selling a put or a call. So it's really the same strategy. I'll just use the bear spread to talk about this since this is the one I use most often nowadays, if I don't already own the underlying. So to start, what is it? Well, a bear spread is where you sell a call at a particular price, then buy another call with the same expiry, but at a higher strike price. So this way you end up with a net credit transaction. So I'll go through examples of this to show you on the Trader Workstation how the graph looks like and why I do these types of trades. Obviously, the pros of doing this is that it's cap. I know exactly what my max loss will be, which is the spread credit minus the difference in strike price. I also am writing contracts where I get paid because it's net credit. So the corollary to this is that your gains are also limited and there's a cap, and there is the infrequent risk also of a short call buyer exercising the option. So those risk reward potential overall, to me it's pretty good. So that's why I take them. So let's go through some examples of what trades I've taken and how I found these. So step one, because of the options are still tied to the underlying, so the first step is really to evaluate the technical and the fundamentals of the stock. I'm not going to go over what stock to pick and so forth, but I'm assuming whatever list you're looking at for the options are the same list of tickers that you're comfortable trading for whatever reason they are on your watch list. In terms of the technical, it's the same as in day trading, which Andrew and many others in the Bear Bull Trader community have talked about, right? Like your daily levels, your pivot points, your moving averages, and so forth. So one would also need to be aware of some important dates, like earnings, product news, regulatory news, etc. Any of these can elevate the volatility of the stock and hence affect the spread and premiums of the options. So step two, once you've kind of defined the ticker we want to play and its associated price levels, this clues us into where we want to take a position. Now I start by going through the different tickers and seeing whether the options pricing makes sense. And what I mean by that is whether the spread between the contract that I'm selling and the contract that I'm buying has a big enough delta to make it worthwhile. So let's look at a bad example, such as Etsy. Now this is a bad example because if you look at this, notice that as we go down the bid-ask spread of each of the successive pairs, we see that the spread gets progressively worse unless we're at the money. I looked at the difference between the bid price for which I sell a contract and the ask price when I buy a contract as a starting point. Notice how if we look at the strike price at the money price of $132, the bid price for selling this contract is at $1.08. Then if we go one up and we see that the ask price to buy a call is $1.02. So that leaves a net credit of $6 minus a piece for the commissions, and you're left with really just $4. So there's not much meat in this unless you want to risk more and perhaps buy a call at a strike of 134. So I tend to stay away from something like this. And then if we move further out, same ticker, it gets worse. So for example, we go down to a strike price of 135 for selling a call, you get $66, but buying a $136 a strike price call costs us $66, and so you're basically out $2 on commissions, and you risk losing $100, but you're not getting really anything as a return. So this is not good. This would be something I would avoid playing. Spot is another example of a ticker I would skip. Look at the strike price of 134. Here you sell for $55 and then you buy for $65. It's a net debit with no upside. So obviously in these examples, we are assuming you're locked into selling at bid and buying at ask. On TWS, you can specify your own prices so one can get better deals, but examples like these two are ones that I would pass on. A good example here that I'm going to go through is NVIDIA. So for NVIDIA, when the strike prices are about $2.5 bucks away, they offer a decent payoff if you select the appropriate ones based on levels. So note how at each successive strike price level, the difference between the bid-ask pricing of the respective one above it has a large enough delta to warrant taking a trade to capture the net credit premium. So the same can be said of QCOM as well. So how I select the strike price again is based on levels and spread amongst other factors, which I won't go into here. Suffice to say, this ticker paints a better picture than Etsy or Spot before it. So how does the profile of the strategy look like? So for example, if we use an NVIDIA again, where I took a position, so this curve is representative of how the max gain and loss looks like if plotted out. So the area under the curve up here is the premium we would get if the option expires worthless and maintains a price lower than the strike price. However, as the price moves up above the strike price, then the loss would be the delta between the two strike prices. So two things of importance to note is that the profit probability for this move is very high in this particular example at this given moment in time. It's over 84%. Furthermore, all of these trades are not ones where I set it and then forget about it. I actively check and manage the trade once I'm in it, depending on how the underlying is performing. So this last point is important because if we look at the expected value, it would look unfavorably when trading options. This is because if we are to do the same simple math here, where we take the return times the probability times the number of times we take this trade, we'll see that our loss would be greater than the return. However, this can't take into account the tactical adjustments made during the trade. So there are a number of ways to play options, whether it is running it in your favor or against you, whether it's running in your favor or against you. I'm not going to go into that here, but that's where the expected value doesn't really tell the complete picture. That's more for, in my opinion, more for things where you can't adjust along the way. Once you sort of place your bet, so to speak, you're done. So it's kind of like the like if you're gambling or whatnot, right? Like you put all your money on 5 black or something. That's it. You can't adjust it once the play is in motion. So if we go through some of the positions that I've taken here, you see that with this FSLR trade, when both options expire outside of the strike price, I would have netted $38. With NVIDIA, it's 32. For United Airlines, it's 12. With QCOM, it's 17. So all in for my bear spread plays that I'm showing here, I'm gonna net $99 by the end of the week, which obviously it's already expired. You know, it's a good way, assuming they expire to 0, which they have, fortunately. Then just gain $99 just for writing these contracts. So it's a good way to add gains just by doing some quick math and then looking at the setup. So hope this helps. If people do bear spreads differently, very interested in knowing how you guys play bear spreads. So feel free to leave a comment below. And yeah, thanks for watching, and don't forget to like and subscribe. All right, peace out, guys.